Hello and welcome back to another exciting video on Smart Finance HQ. Today, we are diving deep into the world of value investing, a strategy that has made legendary investors like Warren Buffett incredibly wealthy. In today's video, we will systematically break down the topic and explore the various principles and strategies that you need to master to get yourself on the right investing track. So, whether you're a seasoned investor or just starting your journey in the stock market, this video will provide valuable insights into the art of value investing. First, let's start with the basics. What exactly is value investing? Value investing is a long-term investment strategy that involves searching for undervalued assets or stocks in the market. The idea is to buy these at a discount to their intrinsic value and hold them for the long haul, allowing them to appreciate over time. But what is value? How do you find it? Well, value in the context of value investing refers to a company's true worth or intrinsic value. Intrinsic value is a fundamental concept in value investing, and it's determined by assessing a company's financials, earnings potential, and other factors. To calculate intrinsic value, investors often employ various methods such as discounted cash flow (DCF) analysis. This involves estimating a company's future cash flows and discounting them back to their present value. The resulting figure is the estimated intrinsic value per share. Intrinsic value takes the following factors into account. 1. A company's earnings. The profitability of a company is a significant factor. Higher and more consistent earnings often indicate a higher intrinsic value. 2. Its growth prospects. Companies with strong growth potential are usually assigned a higher intrinsic value. 3. Their financial health. A company with a strong balance sheet, low debt, and healthy cash flow may have a higher intrinsic value. 4. Dividends. Companies that pay regular dividends are often favored by value investors as they contribute to the intrinsic value. 5. Its competitive position. Companies with a sustainable competitive advantage, or economic moat, tend to have a higher intrinsic value. Now, let's talk about one of the key metrics used in value investing: the price-to-earnings ratio. The PE ratio is calculated by dividing the current stock price by the earnings per share of a company. It's a crucial tool for assessing whether a stock is under or overvalued, so grab a pen and paper and let's dive in. Here's how it works. Suppose you're considering investing in company XYZ, and you want to evaluate whether it's a good value investment. The current stock price of company XYZ is $50 per share. Company XYZ reported earnings per share of $5 in the last fiscal year. Now, you can calculate the PE ratio by dividing the stock price by its earnings per share. In this example, Company XYZ has a PE ratio of 10. This means that investors are willing to pay $10 for every $1 of earnings that the company generates. Here's how you can interpret the PE ratio. A PE ratio of 10 suggests that the stock is trading at 10 times its earnings. Generally, a lower PE ratio, example, below 15, might indicate that the stock is undervalued or that investors have lower growth expectations for the company. Conversely, a higher PE ratio, example, above 20, could suggest that investors expect higher future growth and are willing to pay a premium for the stock. Keep in mind that the interpretation of the PE ratio can vary by industry and should be considered alongside other fundamental factors when making investment decisions. No discussion on value investing is complete without mentioning the Oracle of Omaha, Warren Buffett. He's one of the most successful value investors in history. This is what Warren Buffett has to say about value investing. Value investing is about buying a dollar for 50 cents. It's about patience and discipline. You don't have to swing at every pitch, wait for the right pitch. Keeping this in mind, let's now delve into the key principles of value investing. These principles are the foundation of your strategy. We can start off with margin of safety. Imagine you find a company with a calculated intrinsic value of $100 per share. However, its current stock price is only $70 per share. This represents a 30% discount, providing a margin of safety for potential market fluctuations. Next up, we look at long-term perspective. Warren Buffett's investment in Coca-Cola is a perfect example. In 1988, he invested $1.3 billion in the company. Over time, that investment has grown to over $21 billion, showcasing the power of long-term holding. Lastly, and perhaps most importantly, we come to fundamental analysis. Let's say you're analyzing a tech company. You'd look at metrics like its revenue growth, profit margins, and competitive position in the industry. If you find a company with strong fundamentals trading at a lower PE ratio compared to its peers, that might be a value investment opportunity. Now that we've covered the principles and strategies of value investing, let's talk about how you can apply these principles and identify value in the market. Here are some real-world examples. 1. Financial ratios. Consider Apple Incorporated in 2016. The stock had a PE ratio of around 10, significantly lower than the average PE ratio of the tech sector. This signaled that Apple's stock might have been undervalued. Investors who recognized this and bought and enjoyed substantial gains as the stock's price caught up with its intrinsic value. In 2016, Apple's share price averaged around $24 to $29. As of 2023, the price currently sits just under $200 a share. 2. Economic moats. In the context of investing in business, is a metaphorical term that refers to a sustainable competitive advantage that helps a company maintain its market position and protect its profitability over an extended period. Just as a moat around a castle provides protection from invaders, an economic moat protects a company from competitors. Warren Buffett's investment in Coca-Cola is a prime example here. Coca-Cola's strong brand, extensive distribution network, and long-standing customer loyalty create a substantial economic moat. This competitive advantage has allowed the company to consistently generate profits and pay dividends for decades. 3. Contrarian investing. In the words of Warren Buffett, sell when everyone is buying and buy when everyone is selling. During the 2008 financial crisis, many investors were selling off stocks in panic. However, Buffett took a contrarian approach and invested $5 billion in Goldman Sachs. This move not only helped stabilize the financial system but also generated significant returns for Berkshire Hathaway. So, how can you apply value investing principles in your own investment journey? Start by educating yourself. Just as Buffett learned from his mentor Benjamin Graham, it's never too late to start learning. Read books, attend seminars, and follow reputable financial news sources. Next up, build a diversified portfolio. Buffett's portfolio includes a mix of industries, including banking, consumer goods, and technology. Diversification helps spread risk. Next, be patient. Take a page from Buffett's playbook and practice patience. Some of his most successful investments took years to mature. Utilize the principles and strategies discussed in the video. When studying different companies, make sure to utilize financial ratios and have a good look at all factors that can impact its intrinsic value. Let the oracle's words ring true when he says it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Moving forward, stay informed. Once invested, follow the companies you invest in closely. Keep an eye on their financial reports, quarterly earnings, and news that may affect their business. And lastly, learn from the masters. Study the investment strategies of successful value investors like Warren Buffett. Their experiences and decisions can provide valuable insights. And there you have it, a comprehensive guide to value investing, complete with principles and strategies backed by a few real-world examples. Remember, value investing is not a get-rich-quick scheme. It is a disciplined approach to wealth building. If you found this video informative, please give it a thumbs up, share it with your fellow investors, and don't forget to subscribe for more in-depth financial content. Feel free to leave your insights and experiences with value investing in the comments below. As always, Thank you for joining us on Smart Finance HQ. May your investments be prosperous and your financial future bright. See you in the next video.